In this video, I'm going to talk about the adjusting entries. In my previous video, I introduced the topic and went over one example. And in this video, I'm just going to continue with examples of prepaid expenses. First of all, just to refresh your memory, adjusting entries are done at the end of the accounting cycle, typically at year end. And these are to record revenues in the period earned, record expenses in the period incurred, and update asset and liability accounts. And I also went over some terminology in the previous video. And just to review, deferred expenses simply means advance payment of expenses. These are expenses that are paid in advance. Some examples that a lot of books like to use are prepaid rent, prepaid insurance, and office supplies also technically fits in this category. However, any expense could be a deferred expense if it's something paid in advance. Prepaid expenses are recorded as assets, and then an adjusting entry would be needed to show the asset use. And this is done by transferring the amount or a portion of the amount of the expense from the asset account to the expense account. And then also another thing I should mention, assets are economic resources of a business, things that will benefit the business in the future, things they'll use over time, whereas expenses are costs of operating the business, and they typically reflect things that have been used up in some way or will be used up in the current period or something to that effect. So what you're doing here is simply moving it from that future resource account to the cost of operating the business account. And first, we're going to go through a prepaid rent example. Over here on the left, this is when the company pays rent in advance. It would go in a prepaid rent account, which is an asset account on the balance sheet. And it simply represents the fact that they have this rental space as a resource to be used in the future to assist in operating their business. And then as they use the rental space, as it expires or it gets used up over time, the amounts would be transferred to rent expense. Expenses represent costs of operating the business in the current period. So this is an expense for something that's being used up currently or in the past, whereas prepaid is something that they will use in the future. So let's look at some journal entries related to this. Let's assume that a company pays office rent of $7,200, and this is for a 6-month time period from September of 2025 to February of 2026. And they are paying this on September 1st. So it is all prepaid rent at this point. And this is what that journal entry would look like. Prepaid rent would be debited to add to the prepaid rent account, and cash would be credited to subtract from cash. These are both assets. And the rule of assets are you add to them with debits, subtract with credits. So the one you're adding to would be the debit. The one you're subtracting from, which would be cash, would be your credit. And then by the time year end happens, this company would be doing their adjusting entries, and they would look at this account and adjust it for what has been used up. So just assume they do their adjusting entries on December 31st. At that point, they've used up the rental space for September, October, November, and December. That is 4 months. So 4 months have been used up and should no longer be in the prepaid rent account. So you could divide by 6 months, first of all, to get how much that rental is per month. $7,200 divided by 6 months equals $1,200 per month. And then you would multiply that $1,200 times the 4 months that have been expired or used up. Different textbooks will use different terminology, so that's why I put both of these words in here. You could use either term, but the point is that time has passed, and this amount, the $4,800, should no longer be in the prepaid rent account since that amount has been used. Even if they didn't actually physically use the rental space, they still paid for that rental time period, and that rental time period has passed. And this is what the actual entry would look like. Rent expense would be debited for the 4 months that have been used up. You're adding to the expense account with this entry. And then prepaid rent would be credited for the $4,800. This subtracts from the prepaid rent account. I'm going to show you this in the T accounts. So we have prepaid rent, cash, and rent expense. The first entry on September 1st was a debit to prepaid rent, credit to cash. And then the adjusting entry at the end of December was a credit to prepaid rent and a debit to rent expense. And then if you were to calculate the ending balance in prepaid rent, that would leave a $2,400 balance because remember, debits and credits offset or subtract from each other. The difference between these two numbers is $2,400, and it goes on the debit side because this debit amount of $7,200 was larger than the $4,800. And this basically represents the 2 months that they still have prepaid. They still have January and February of 2026 prepaid. And then more than likely cash would have other transactions. But I just went ahead and put the balance as a $7,200 credit, even though typically cash has a debit ending balance. So just know that there would normally be other transactions here in cash. And then rent expense, that has a $4,800 debit balance to represent the 4 months of rent that have been used up in that year in 2025. So you've got 2 months still prepaid here, 4 months over here. And these are balance sheet accounts. This is an income statement account. Okay, let's look at a prepaid insurance example. When a company first prepays insurance, if they're paying for insurance in advance, it would go in the prepaid insurance account to represent that this is an asset. It's a resource for the company. They'll have that insurance coverage over time as they have that policy in place. And then as the insurance coverage gets used over time, or it expires, they don't necessarily have to use it, but the coverage would expire over time. Even if they don't file a claim, they still had the benefit of that insurance coverage. As it's being used to insure the company, it is an expense of the business. It's a cost of operating their business. Whereas when it's prepaid and something they're going to use in the future, that is more of an asset. Something they've already used up or they're using currently is more of an expense. So let's look at this with some entries. Let's assume that a business pays insurance of $12,000 for 12 months of insurance. They pay it on July 31st, and this is for coverage for the time period of August 2025 to July 2026. When they pay that insurance on July 31st, they would have a debit to prepaid insurance because at this point it's prepaid, and a credit to cash for $12,000. And then by the time they get to year end, they would be doing their adjusting entries and some time would have passed. Let's say it's December 31st. In that case, they would be adjusting for prepaid insurance that has expired. In other words, the insurance coverage was used for the August to December 2025 time period. You don't count July because it was at the end of July when they paid for it, and they were covering August through July of 2026. So we're not going to include July in this calculation as far as calculating how many months have expired. We're going to count August, because that's when the policy started, September, October, November, and December. So by the time they get to December 31st, 5 months have gone by, and an adjustment would need to be made for the 5 months of insurance coverage that has been used up or expired. So $12,000 divided by 12 is $1,000 per month. 1,000 times 5 is $5,000. And this is what the entry would look like. It would be a debit to insurance expense to add this to an expense account, and a credit to subtract from prepaid insurance. The original entry was a debit to prepaid insurance. To add to it, and this entry would be to subtract from it by doing the opposite, by doing a credit. And I can show you this in the T accounts. Here we have prepaid insurance, cash, and insurance expense. The first entry was a debit to prepaid insurance, credit to cash. And then the adjustment was a credit to prepaid insurance and a debit to insurance expense. And then you would calculate the balances. 12,000 as a debit minus 5,000 as a credit would be a debit balance of $7,000 in prepaid insurance. This represents the 7 months of insurance coverage that's still prepaid. They still have January through July of 2026 prepaid at this point. Cash would normally have other transactions, but I didn't want to add a bunch of random numbers here, so I just left it as is. This transaction had $12,000 coming from cash as a credit, and then insurance expense would have the $5,000 debit balance to represent the 5 months of insurance coverage that they used or had the benefit of using in that time period while they were operating their business. And then just keep in mind that these are balance sheet accounts, and this is an income statement account or a profit and loss account. And then it's worth mentioning that I do see companies do these adjusting entries monthly instead of yearly. It just varies by company. But in practice, I see companies that want to have their monthly financials a little more accurate. So they might do this adjusting entry every month for $1,000 instead of waiting till December to do all 5,000. So I hope this video was helpful. I will continue with more examples and move forward with other adjusting entry categories in the next video. If you have any questions, feel free to comment below, and I'll see you in the next lesson.